right. We're back, Kevin. If you're up for it, Kevin, I might, or Mike, let me make you guys co-host real fast. That way we can open up spaces. Again, if you drop off, it's not a big deal. It just basically allows for extra speakers.
What's up,
Okay,
Robert?
perfect,
I'm
guys.
actually
Hey, man.
I'm in the car right now. I was about to do
Yeah.
a late show episode because I'm feeling it, but I don't know how long I'm really going to be able to stay on here. But
Hey, no worries, no worries. I found out that basically if you add co-hosts, it opens up other speaker slots. Like they cap the speaker slots to like 10. So if you have to drop off, man, I'll just make somebody else co-host. That's all. So we just ran into that in the past, but I appreciate it.
cool.
Oh boy, Leslie's got a rosé and her notebook. We're ready to go. Gavin, safe driving. Hopefully, I don't cause you to crash the car. But I guess we'll have a real time, late night session. And yeah, so I mean, for those that joined earlier today, appreciate it. Always a pleasure to chat about notebook review on a Wednesday night. We definitely got through a lot earlier, and I think there's still a lot to cover, to be honest, which is fascinating and always good to have. So pretty casual. Obviously, if you've done this before, you know kind of the how we kind of the session and kind of how we work this out. But basically, if you got any questions or commentary, you want to chime in, this is a very open forum. Just hit the request button, and I'll do my best to loop you in anytime. So yeah, I mean, Mike, you and I were kind of going back and forth a little bit on Xlre. Do you want to? I thought it was a good sort of messaging. Do you want to maybe expand on that, or sort of maybe we could take that to the group a little bit more?
Yeah, that'd be. I think that's a good idea.
Yeah, why don't we start there? Yeah, because it's a hard one and one that I've struggled with myself in terms of strong signal strength, tight risk range, etc. But I'll let Mike kind of expand on it.
Yeah. So the question that I was talking to Rob about was the risk range on Xlre is basically like a 2% range, 2% spread, and so Gavin, actually, I was going to ask you this towards the end of the last one, but we kind of ran out of time. Looking at something that has a tight range like that, if you're trying to trade that range, you're not really going to, there's not a lot of upside, obviously. And I think one of the things we were talking about was that, the REIT sector in general is really like a fixed income alternative, so it's going to trade with similar characteristics as fixed income. So I think the volatility is just not there, and you see it in the risk range. Yes,
and, and then on top of that too, I would say it's like, when do you step in, right, Gavin? I know you said basically single strength. I told you today that even though it wasn't at the low end of the range, you wanted to get a piece of that. Basically have that allocation in your portfolio. And I've certainly struggled with that myself in terms of like, okay, it's middle of the range. I've kind of thought that it was going to, obviously, good entry point. It's been strong, and then it basically goes to the low end of the range, right? So, Gavin, I don't know. And again, I know you're in the car, so it could be a little tricky. But beyond just signal strength, was there anything else that was? I mean, had it been on your radar? Did you already have some exposure and you added to it today out of curiosity, or like how did it? Because I actually do have some exposure Xlre already in the portfolio, but it's tiny. It's like probably 150 basis points. So just curious, kind of how your thought process beyond just signal strength, buddy.
Yeah, no, it's been on my radar, but like as soon as I get my hands on Keith's range, like I can very quickly like just go in and get a read on where I think the strength is, and then obviously looking at the roadmap, it's like something that I would want to start building. But yeah, I mean, for me, it's like I put a half size position on today because if it stays this strong the way it's signaling right now, I would never take it below half.
Right.
And like the shares that I bought today, um, and I put some leaps like in my more like leverage strategy account.
Sure.
I used VNQ, but like though I don't plan on touching those. Like I'm hoping that that's going to be an intermediate term trend that I'm just going to be in. And so so now I have like my base position, and yeah, it wasn't at the bottom of the range, but it just needed to be done. And so from here now I can like fill it out to full size if I get an opportunity immediate term. But yeah, I guess the thinking is like based on the signal strength I see right now today, I would never take it below half. So why not just put half on? Like I need to get money to work, And so,
Yeah.
yeah,
And so
that's it.
just from a process oriented standpoint, Gavin, when you say kind of your initial full, do you take that to 2 or 3, 300 like basis points?
Yeah, so that would be, I mean, it could really be 4, like,
Okay.
REITs or lower beta. So
Right.
it could be max long, like XLRE. I would be comfortable doing something like 6 to 800,
Right.
basis points.
Okay.
Um,
I think
you
that's
know,
helpful just right and again, everybody's situation is different, right? I mean, everybody's portfolio is a little different, but I think that is helpful, right? Just to understand the thought process there. Because I would agree with
yeah,
you,
sure.
right? I would definitely take it to 6, with no problem, and if it leaked up to 7 or whatever, right, because of strength, I wouldn't necessarily immediately go to curtail it, yeah, that's a good point. And so you again, sorry, not to pick on you, man, but did you basically put on a full like 300 point? You just kind of said let's just put on 300 points, basically.
Yeah, I do that quite often where it's just like I'm moving money here, and
Got it.
I'm sure some of you guys can like sit and pick a better spot and get us. I was talking to a guy who I think like bought ITB, at the lows in the last couple of days. That was his first buy, and I just told him I was like, "Excellent, man! Like you got a great price. That's been really strong." For me, like I bought it higher and I still have a half size position, but I just want that on,
Mhm.
so based on like where my 9 to 5 job is right now. And like, I just can't, I'll try to use limit orders here and there, but I
Right.
just need to get things working.
Yeah. No. 100%. I think that makes sense. So, Mike, yeah, I mean, I think basically the short answer is, a little bit two different philosophies. Like Gavin wanted to put that money to work, where I kind of got approached it a bit more from a tactical standpoint, right? Because I will sort of trade it a bit more, where I'd rather try to go pick something else out that, although it may have really strong signal, I would rather kind of incrementally add, kind of certainly, maybe a little bit closer to the bottom of the range, right? Where you had, you know, maybe a percent of like downside or what have you, right? In terms of like the low end versus kind of where it was yesterday or even today, kind of in the middle of the range. But again, I think that's just two different kind of kind of philosophies, investing styles per se, and that kind of thing. So I don't really think there's, I wouldn't say there's a right or wrong way of playing it. And yeah,
It's kind of similar to what we're talking about with gold as well.
hundred
It's
percent.
about,
No, so go ahead. Yeah, so for those that don't know, I mean, gold basically obviously has had a big move today, right? And it's a pretty valuable asset to have on, kind of thinking, Q2, potentially Q3 with quad force on the horizon. And again, similar type of thought process around bonds as well, right? Just fixed income in general, and kind of having that player back on the field. I love that terminology from, I think, we've sort of stolen it from, was it, I always forget his last name, but he's been on, anyway, it doesn't
Diego
matter, but
Puri.
thank you. Yeah. Diego. And yes, I mean, I think having these on your horizon for when you want to take a position or add to that portfolio allocation is really important. But the patience sometimes, especially with things like gold and fixed income, there's always kind of a day where you think you won't be able to, or there's multiple days, weeks, perhaps even, where it keeps kind of running away from you, then all of a sudden you get an opportunity. And I think being able to either set those limit orders, as Gavin said, right? If you can't be as on top of things, move them up with the risk range. Luckily, IEF, I know had some conversations earlier about duration, but, IEF obviously tracks the 10-year very closely, but I mean, TLT would be another, similar one. LQD is obviously a little bit different, but they do all kind of trade similarly. And so kind of moving those risk ranges or limit orders, that's at least what I do in my process, right? Is because I can't always be, tactically trading and stuff like that, is sort of using those general risk ranges to, create those asset allocations. And, the other thing too, right now, that's on my mind, certainly in my notebook right now is, there's a near term, there's a near term sort of potential risk on environment, right? Kind of going quad one / shallow quad four, but then there's that kind of like big, potentially deeper quad four, which in the early look today, Keith, I believe, put like a 90%. Again, I have it up. I think it was like 85 or 90% likelihood that that's going to be hitting in Q2. So, I think there's a lot of dynamics here in play that you're kind of trying to set up. And I think we're all trying to do that. Yeah, it was 93.8%. So I think we're all trying to do that. It's just a matter of, I think you got to kind of remember a little bit, sort of forest for trees situation, right? There's like definitely some near term action, pin action that you take advantage of, but then as Gavin's doing, kind of, in hopes of not being able, not touching XLRE because it's like basically a strong performer in, a quad one / a narrow quad four, and potentially obviously equities in general aren't great in a deep quad four, but, REITs certainly outperform others. Jimmy, you did raise your hand. Yeah. I stopped.
Yeah, man. What's up, Robert?
Yeah, hey, bud.
No, it's cool. You guys made some really good points about REITs, and Rob had some really instructive thoughts as well this afternoon. I'll just say that having invested in these companies for a decade, at the dedicated level, I'll share a brief story that might prove instructive too. Like in 2016, when Brexit was going on, the REITs at one point got a crazy multiple. They got a big premium, way more than the valuation driven and the kind of the relative value, play would suggest. And we're nowhere near that yet. I think having been in this space, the thinking was always, we're not the sexy girl at the dance. There's going to be periods where we're out of favor and the market's growing so much quicker. And even the most levered companies are growing their levered cash flow at like 10% on a good year, right? It's like a levered 5 to 10%. So like it's not sexy compared to FANG, compared to tech, but there's going to be a point now where a lot of those larger cap REITs that are in the S&P, in the XLRE, in 0809, there was kind of a credit-driven recession, if you will, or a crisis. What 2020 was kind of a blanket sell-off. But I do think that in whatever comes next, if we have a couple of quarters of quad four, there's going to be even more so today, because the dedicated guys are probably there already, but you're just going to see more generalist capital, irregardless, float into the REIT space, having these discussions that we're having, maybe after the fact, now that they're at all-time highs. I think the difference, clearly there's a difference between REITs today and where XLE and XLF were a couple months ago. They were coming off of all-time highs, the risk ranges were narrow, the markets were at a critical juncture, and we're like, ooh, is this good or bad? I mean, but REITs are looking very strong right now, and even within the REITs, there's so many subsectors that touch on all parts of the economy. You can go long and even short the REITs you don't like. So like, let's say, you're at a 6 or 8% max position, in a quad four scenario, there's just a lot of names to play from. You could be shorting hotel REITs that are very cyclically exposed, that have high debt to EBITDAs, that are having tough comps, and go even longer some of the other REITs you do like. I thought it was fun that Rob mentioned that NSA, it was a more levered storage. I think a lot of people already see the strength in self-storage. So you go along the larger cap names and you short NSA to get to your gross, right? You go long a BXP and you short an SL Green. I love the company, but they're levered, they've got crypto, they got all the quad four bad thingies, right? You go long a larger healthcare name, Welltower, Peak, just off the top of my head, even Ventas, VTR, and you short a Sabra, a more levered, reimbursement based, just a higher perceived risk business model. And then you can get, 20% of your portfolio, not that you would, but it's like different types of REITs, ETFs that are giving you bond plus exposure, right? They're still paying 3, 4, 5% dividend yield in some cases, but also having the short exposure, and then kind of work around your portfolio there. So I do think, right now, if the dedicated guys think that some of these NAV premiums look expensive, when the flow comes, I think there's even more of a moment. But, that's kind of catching the top or catching the bottom. But that's kind of just like a general point that I would make. I'm still hoping we get this little quad one, right? You get the post-Omicron global bump. It's funny that Jonesy's been talking about it, right? And people are there's still that, just wait until they finally capitulate and realize that the deaths are not bad, and that once the hospitalizations come down off the peak. Mike Taylor was talking about it. We got maybe 8 weeks. I hope it's less. I hope it's after the new year. But that's my narrative. But, in that case, we'll have a better chance to maybe buy some treasuries, maybe buy some REITs, right? When people are trying to catch that last bid of that cycle.
And that kind of speaks to what I'd mentioned in terms of like kind of there's definitely like near-term OODA loops, right? While thinking about the longer-term asset allocation, and it's kind of like trying to think with both sides of your brain or what have you, and positioning yourself and taking advantage of opportunities when they're here and in front of you, like we just have had in the last couple of days, where nobody wanted, not nobody, but it was certainly a end of the world was coming on Monday morning. Jim Cramer with his 3 vaccine cards and what have you, looking like he was about to die on live television. And then 2 days later, you got VIX in the high teens and still chop bucket, but the market's has completely rallied, and now it's risk on appetite appears back, right? And so I think that's where
actually.
Go ahead.
To that point, Robert, I wanted to add some of these things were kind of anticipated. So let me elaborate on that. Usually, the day after OPEX, it has been studied at least for the last 8 quarters that the day after the options expiry, which happened on Friday, there's usually the Monday after is a bit of a chop market, and that sets a very good positioning. And there's a lot of work on this. There's a person who is popularly known as Jam Kursan, or he was an ex-market maker. His actual name is Kim Karasan. He has done a ton of work on this because he runs a volatility fund called Kai Volatility, and he has given a ton of detailed studies around that, or one can find those studies as well. With
That's
respect
awesome.
to the options expiry getting over, and on leading into the options expiry, there's a little bit of a window of non-strength, which is what we saw last week. Mm-hmm. And the day after, we have a little bit of a chop, and then a couple of days later, as the dealer does position themselves well, it ends up vanishing away, the position of non-strength. Then comes in the seasonality. There's a seasonality aspect that jumps into around when 6 days of market or 6 days of trading is left for the year in the market. It has been almost 18 out of 20 years, last 18 out of 20 years, it has been significant strength, just, buy the dip, especially. And this time it was a nice confluence that the OPEX happened. And right after that, after the Monday opportunity, we ended up going into that zone. That's why I was actually slightly surprised that on Monday, Keith had that signal, which was indicating slightly towards quad 4. Nonetheless, I mean, for my own personal investment, I'd raised some cash the previous week when we had that sharp rally. I was waiting for that kind of a chop. I was just grabbing it with both hands, both in the futures as well as in the strong names that we have right in our list, and especially building out, deploying that cash. I had almost 22% cash at one point of time on Friday, and Monday was a great time to just allocate out based upon the percentages. So I wanted to check with you.
I was in a similar boat, Monique. You know, it went from like 25% to like 15 or whatever, right? It was a great time to deploy.
Right. I had a quick question. So today there was a revision of the GDP, right?
Mm-hmm.
Does that change or alter our notebook stance significantly? It was revised considerably higher for Q3.
I had not seen that actually yet, so I don't have a good comment, but
Okay, no worries.
yeah, sorry, man.
No worries, no worries. Usually sometimes
I would think that if it was, it's going to be, yeah, it's going to kind of, I guess, impact a bit rear view thinking, right? So I think that's
right.
where, you know, I think if you go to that like quad map or grid map, whatever you want to call it, you know, it likely just kind of changes the location of where that lands, right, in terms of like post real numbers versus what. But I
So
guess it
does
would.
that
But I
pose
guess it
us
would. I guess it would impact though, kind of the rate of change for next year. So you know,
exactly? And
yeah. So that's where I think the quad. You know, right now I think Q3 is slated. It's kind of right on the right on the cusp of quad 1/quad 4. So if it's got tougher comps, then that would likely push it closer to, you know, back to back quad 4s, which
exactly,
is
yeah, that's what I
yeah.
wanted to ask. That wouldn't it pose for us? So this becomes a market much more for us to be extremely actively managing rather than, you know,
Yeah.
taking it for a nice ride. Because at least I would admit very gladly that since last 1 month, I've been literally actively managing every 2 3 days all my positions, which previously wasn't the case. I was able to write it out that, okay, I got into Google at say 2,500, just set it out and it goes to 2,900. No, no, no. That's not happening right now. The Google Wix literally hit 31 on Monday.
Mm-hmm.
And I was like, wait, that's like a great opportunity. Let me just wait for that Google Wix to start collapsing. So as it started collapsing, then I jumped on to buying Google. But that was you know, part of the agile process that I learned in the last few years. So it was really helpful to be able to build that. Otherwise, just going by the typical narratives, I would have been just thinking, oh, should I take it or not, or just buy and hold or whatever. But yeah,
Completely.
it's yeah. So from my standpoint, I think at least what I have experienced is that I had to extremely actively manage both the beta of the portfolio as well as the overall exposure to individual names. Especially, I trade a lot in Fangman individually to the max
Yeah.
6%.
Yeah, and that sounds right. I don't know if you've attended other ones in the past, but I mean, Gavin, you know, treats those basically as their own little macro, their own little kind of macro positions and the fake names, right? All those, excuse me, all those core ones. But yeah, man, I think you're exactly tackling it. You know, certainly the way that I approach it, and I have been, you know, trading a bit more frequently, certainly, you know, than I
It would
was
be
in the.
great to have Keith on one of these events in the evening. I don't know if he's available at this time. I know you had one earlier also in the day, but the second part I wanted to also add was that maybe, you know, something, especially with the revised GDP being steeper, if that could be addressed in maybe the early look or one of the other products, that'd be awesome.
Yeah, I mean, I don't know if you subscribe to the Macro Show, but I'll certainly, you know, if you want to DM me your question, if you don't, I'm happy to ask it and we can go from there.
Sure.
But yeah, man, it's you know, it's a great question, and you know, just kind of how that impacts. Again, I would suspect that's going to, you know, if you're kind of thinking down the road, it's going to be a tougher comp. You know, if it was revised higher, so it's going to be a tougher comp year over year. So that rate of change again. I mean, just that you know, I mean, right now, again, I think, you know, across the board, you're seeing, you know, growth is the biggest, you know, probably outlier or X factor that we're having to try to consider. And whether, you know, again, whether it's Omnicom here that's impacting kind of like what occurred in the summertime with the Delta variant, impacting some near term growth. So, you know, pulling forward some of that kind of year over year quad 4 type, you know, which is what the market's been giving us and signaling. And therefore, you know, what does that look like then for Q2, right? Does that kind of change things out? Do we get a kind of a ramp in acceleration in growth. I think right now, I mean, that's the biggest outlier in terms of, what's that going to look like as we head into 2022, and therefore, you're likely going to have to kind of manage the book a lot more closely. That's for sure.
I would say one last comment on
Yeah,
that.
please. Yeah,
I think you
back.
need to.
Hey, Dibsy, thanks for circling back up, man. That was awesome.
Yeah, no,
Appreciate
this
it.
is the first one of these chat rooms I've been in. So
Yeah,
back in the day, it was more on Discord, but that was all over the place.
Well, I appreciate the I appreciate it.
Yeah, no, I was just gonna say, from a practitioner's perspective, and I follow Hedge. I really enjoyed the risk management process, but I work at a family office on the investment side. Just for a little bit of background on myself, but towards that point on the revision to GDP, I would really not, put a lot of weight in that being something that the market cares about a lot right now, because just the direction of it is pretty in line with what had been happening for the first 3 quarters or whatever of the year. What the market is caring about now and what we're seeing, in the bond market is figuring out what inflation is going to do. So you can look at what's called the break-even curve, which essentially models out what the market implied inflation rate is. And then also
right. And the bond market is saying about 5-10 years down the line, we are not going to have any inflation.
Yeah,
right?
and
it's going to target
5 years
deflation.
out, even 2 years out. What I would say is, like, if you can spend time to really, you can follow the numbers and look at the data, but understand like what the drivers are for the deceleration in inflation and GDP. Like it's mathematically impossible, basically, for us to, from a base effect, have a higher rate of increase in GDP and inflation next year. So, and then it's like, well, yeah, we're coming from 7% GDP growth or whatever down to 6 or 5. It's still high. It's still above long-term trends. But, at that point, it's kind of a question of, okay, are we going to be getting back down to the long-term average faster than normal, or is it going to be slower than normal? But just those are the types of things that I would recommend paying attention to when you're, making your decisions, and less so things that have already happened that everyone already knows, and it doesn't really matter because markets are forward-looking.
I think that's a strong point about going back to above average. We definitely are dealing with a shallow quad 4, a deeper quad 4, and then a relatively more shallow from Q3 to Q2 than versus Q2 to Q1. And so just, you talked about the base effect, like if we end up growing 4 and 4.5% and GDP is still kind of above trend, or inflation above historical trends, you're going to need some place to outpace that. So in the growth sector, you've seen definitely a re-rating of growth stocks from probably ludicrous price to sales multiples. But, I do give the market definitely a lot of credit for, it's been quad 4 for a while for some of the other sectors, small caps, growth, ARC. I think it can go lower if the broader markets go lower, but I do think that however we're thinking about 2022, there's always surprises, right? There's things unforeseen. I think I mentioned earlier a little bit into narratives, but like student loans get extended, the payment pause till May. Then let's say Build Back Better, if it happens in the spring, the implementation of that in the second and third and maybe fourth quarters of the year could also change on a relative basis, in the same way that we were looking to get quad 4 in, I think, even Q3 or Q4, and the signals changed incrementally. Obviously, we have a much tougher comp next year, but it will be forward looking at a point.
Yeah. George, I know you came on. Was there, did you want to kind of dive into your notebook or thoughts?
Yeah. First thing I'll say
You're
is,
welcome.
I hate to even have to say this, but nothing I say is investment advice. But based on the past couple of years of observations, right? So I've been through 2 quad 4s with Hedge Eye. Started with them in the summer of 2018, and really helped me not have a large drawdown into the Christmas Eve bottom of 2018. I believe the major indices draw down about 20%, and our portfolios were on average down about 4.7. So
That's
the
awesome.
observations
Well done.
through that, well, there are lessons learned. So it's good going in, but not necessarily coming out, right? So the bond proxies, utilities, staples, REITs, healthcare, they destroy going into the ultimate freak out, crash, correction, whatever you want to call it. Same thing with the quad four we had before the whole pandemic lockdown drawdown. The actual bottom freak out, which I think everyone should be really aware of two things. One is, I say like the only thing CNN is good for is their fear and greed index. When that thing like hits zero, like clockwork, if you just bought it bottoming in the single digits, you've made a ton of money. And so that's a really good indicator, I guess you could say. And then the other one is quarterly rebalance. So we know how big passive flows are. Vanguard, Fidelity, State Street, they rule the world. Mm-hmm. And they just have to, by rule, regardless of fundamentals, rebalance back to their mandates on the third week of the third month of the quarter, right around your options expiry. Mm-hmm. So if you get very large performance divergences, please be aware of that. Because if anything I've learned over the past 2 years is that I've crushed it going into quad four. Hedge Eye and Keith do a great job of making sure you know what's on the horizon. Like you said, the conditional probability of quad four in Q2 is insanely high. Mm-hmm. Don't just be prepared for the quad four itself, because you will blink and that insane opportunity will be gone, and you don't get it for like 2 years, Right. Then with them back to summer 18, I've seen 2 deep winners. That's it. And this one, we don't have a yield curve inversion. We're not worried about recession. It's just, your routine quad four. Don't miss the opportunity. That's all I want to say is get ready now and be ready,
I love it.
Your notebooks are on point. There's not a time to sleep over the next, 2 quarters.
I would definitely agree with that.
So I'm curious people's thoughts, and I kind of was in the camp of quad 3. What would that be, like start of September? And Keith made the quad 2 call, and I was just perplexed at that for the month or so that it lasted. Ultimately, just looking ahead to 2022, thinking, okay, things are going to start decelerating, then might as well start getting prepared for it. And I feel like we're now kind of at that point where it is, quad 4 is knocking on the door. But I maybe I've misunderstood, but maybe a few people here were talking about, well, there's still a little bit of time in quad 1 left. I'm just kind of curious for people's perspectives here. Is the thought there's still a chance for quad 1, or is it I'm doing quad 1 because the model says, and now, I guess as of today or as of yesterday, now we're shifting to quad 4? I'm just curious how people are thinking about that.
Well, I can go first if you want.
Yeah, go ahead, Mike.
We've been talking the last 2 weeks, whether, it's clear. The only thing that's clear is that we don't know what quad we're in. But I think the signal today, the UUP long and the RTA, that solidified to me that Keith is all in on quad 4 here.
I think the UEP was kind of another type of sell signal. He's going to keep it conditional. He mentioned if I'm early, I'm early. So I think you're right in that. Like, he's largely talking about bonds, right? Like how much airtime he gave to bonds on the macro show. But certainly, depending on what the signal says, I'm still bullish. We're what, 1% off the high for the S&P. I definitely think if there's even short covering, if there's even just short coming from Omicron, not that everyone goes longer or like net leverage increases, you see how funny things are when we're teetering. Like a day or two can heal charts, can break charts. I'm a fundamental guy. I see in the small caps and micro caps that I'm in. I mean, I see generational opportunities, but I acknowledge like the charts look awful, but the market
Yeah.
is full of weird dislocations and bubbles and pockets of illiquidity. And so people are definitely confused. Everyone's trying to figure out the macro. People are not thinking about business operations. It's just a weird time to be allocating capital. So, I think people are right to be cautious.
Yeah,
I
to
do think
address
there's, yeah, go ahead.
Sorry, I was going to say to address Dipsy's point, the quad one or quad four is data driven. And as of right now, as Keith has mentioned, or as we have seen in the data too, it is pretty much, we'll get to know slightly after. But what's happening with the oscillation on the signal front is that there are days like Monday, but they are happening for a factor, which is the day after the options expiry and the dealer desk wanting to do that along with low liquidity. And then that is oscillating or misleading the signal using price on the trend side, stating that it would probably be a bit of a quad four ish. But as we heard earlier, with respect to the mathematical impossibility in next few quarters or thereabouts, we are going to have a bit of a challenge trying to establish quad one and keep it. So we probably have quad one maybe for a little bit of time, and then we might have a quad four situation, which we'll have to keep tracking the data. So, uh, you know, we're at one of those turns where we have to keep actively managing the book, but also take advantage of opportunities like Monday where we deploy, and then when we get these sharp rallies, just get out, right? I trade the Fangmans, and Google going below 2800 on one hand was a bit of a question on the signal front, but at the same time, with Google X hitting 31, and then when it started dropping off, it was a clear cut, otherwise trading opportunity to just go in and buy all in on Google calls and then just unload them a day or two later once the trend has changed. So, from my standpoint, to address Dipsy's question, because it is so much data driven, uh, we have to just keep waiting for the data to come in and then eventually be ready, be extremely nimble footed would be my thought process. But the quad one, quad four is still um, a question. We are still heading, in my opinion, we are still heading towards quad one, but we might blow back into quad four depending upon the signal. At least into the year end, I'm kind of bullish. What happens on the other side will depend on how soon the shorts get to establish their position as well. Because the signal is trying to front run the quads, so we don't have concrete data yet, which will give us quad one or quad four yet. Dipsy, does that?
Yeah, no, I was kind of just thinking, like, I was curious of other people's thought process. If eventually we're going to be in quad four and we're going to stop at quad two for a couple of weeks and then quad one for a couple of weeks, I guess like last week, Keith was still in the quad one bucket, it sounds, or maybe started shifting. I guess it was kind of just an open-ended question for how people were thinking about it.
Yeah, at least I've struggled with trying to figure out on this last quad transition, where we are. And, once Keith started talking, like Jimmy was saying, or someone was saying, just talking fixed income and bonds and pushing bonds. If we were quad one, Goldilocks, I doubt he'd be that focused on fixed income and dollars and, basically anything but the equity markets. That's why I think, he's solidifying his quad 4 call. That's my opinion.
Hey, I don't mind to jump in if it's okay. I go by Options Gunner. Call me JD. Canadian and American, so dual here. Thanks for having me on, Rob. It's been a long time coming. A lot of great thoughts here on this, and Rob knows I look at the options market a fair amount to see what instructive things I can pull out of that, in addition to the Hedge Eye Notebook, in addition to price, volume, volatility. Definitely like a discussion here on quad 1 versus quad 4. I mean, obviously, you have a bearish signal in oil right now, obviously with bearish trade, and so that's something to think about. I mean, if we were quad 1, maybe we get to neutral. It's possible you have a little bit of a knife fight there. You're looking at nat gas, so there's some thoughts around that. For me, the thing that's really interesting is you really don't have this call buying frenzy at all. There's just not a lot of interest, even in beyond like Tesla and Apple. There's just not much excitement going on. And what's also equally interesting is, the things that are kind of flip flopping around, moving around. So you've got, financials, you've got the oil stocks. They're having a little bit of a bounce. There's really not much options activity either way on those either, which is something to think about. There were some pretty large XLU trades that went in last week that were interesting, and I have not seen that in the last 2 years or a year and a half, where you're having more quad 4 type big buys going down in the options market. So just my 2 cents on that as far as instructive. I feel like the handoff will, some weeks may be more of a quad 4, some may be a kind of a quad 3-ish type deal. But I agree with what I think George was saying, that my preparation is on catching the quad 4, because I do think it's going to be fast and it's going to be a face ripper in the healthcare space, bond space. And so it's great that you all are having this dialogue. So thanks for inviting me, Rob.
Yeah, JD, pleasure, my man. And just for the forum, JD and I talk markets, but then we also share a lot of hip hop music back and forth. So, we're Renaissance men. We go all different, all over the board. But anyway,
for sure.
Yes, and just to piggyback off that, I mean, the flow, I think, is so important to kind of keep an eye on. It's something that Leslie is and I mean, and Options Gunner has really introduced me to, in terms of kind of keep having that as like another little toolbox or tool in my toolbox, and having that kind of guide where that next kind of potential, I guess, really flow of capital is going to go towards. And so it's a combination. It helps sort of with signals as they're kind of transitioning or in neutral territory. Like XLB, I think, is a good example where it's teetering on kind of like 1 month sort of like flattish, right, and kind of trying to regain that momentum. But like the flow, last I checked, wasn't really supporting that move in materials, and so I actually kind of cut the rest of my position there. Because of that information. So, I think kind of combining all that detail is really helpful.
Spot on, Rob. And the one thing I was going to say too is if we're going quad 1, you'll see some pretty heavy flow just as far as sweeps at the ask, above ask, in things like Affirm, Live Nation. Like, we're seeing the bounce, but we're not. I don't see a lot of like huge options activity yet. But if we get it, we get it. Like, I'm flexible; it doesn't matter to me. But those are some of the things that I'd look for if we really do go to a true quad 1, to your point. So
yeah. And if anybody cares, Options Gunner introduced me to Trady Ticks, so I can share that as well. But that's where I get, it's like, I don't know, something. Again, I don't want to sound crass or anything, but it's like, I don't know, $40 a month or something stupid. It's like pretty freaking cheap. And so, but the content and the data is unbelievable. So we'd definitely highly recommend. Yeah, Bruce, rock and roll.
Hey guys, how you doing?
Good. Welcome back.
Thanks, man. one thing I was going to say I was trying to get better on is, as opposed to trying to figure out the constant debate of what quad we're in, whether we're 1 or shallow 4, or the pending, obviously looming quad, the real quad 4 in Q2 of next year, trying to do things that will work in all the environments, right? We know that REITs will work in both environments. We know that UTs will work in both environments, gold, bonds. So as opposed to like trying to kill yourself and drive yourself crazy about trying to figure out what quad we're in on a daily basis, try to go with the things that work in both quad 1 and quad 4 and shallow quad 4. The other thing I was thinking about was, it's actually, I don't have an XLRE position on, but in the last 2 quad 4s, we haven't had a read analyst. So I actually I have about 500 basis points of read exposure on right now, and I think 4 of the 5 idea are Rob's investing ideas. So we haven't had a read analyst during the quad 4 before, or during COVID, and the one in the end of 18. So that's a big thing to take advantage of. And then the other last point I was thinking about was to hit on during the previous call. I think it's so important to realize, if anybody hasn't, or if anyone's new to the process or hasn't navigated a lot of quad 4s or multiple recessions, to really think about position sizing. And I know that Hedgeye isn't huge on pie graphs and stuff, but they actually do have one pie graph that they put out about kind of like a broad idea of what your allocation should be in each quad. And if you notice, the one in quad 4, they recommend cutting your positions, I think, down by a third. So I think that's really important, because at a certain point during quad 4, literally everything gets blown up, kind of going back to the point of the last call during the liquidation events. And it's just brutal, because you think you're doing the right thing, and then you start questioning yourself because you're losing money left and right, because bonds go down, REITs go down, gold goes down, everything goes down during a certain point, and it's brutal. So, but that's just part of the game. So anyways, that's my 2 cents, or a lot more than 2 cents.
Hey,
thanks for chiming in.
Great commentary. Absolutely. Yeah. Gavin, go ahead, buddy.
Yeah, I got to get going soon, but I love the comments that I just heard. My connection was kind of in and out, but Bruce, what you were just saying, and then to Mike's point about, Keith's UUP RTA, I just saw that today as just like a gross exposure type signal, and to your point, it's like when you're seeing quad 4 kind of on the horizon, just start thinking about what you just said, Bruce, your position size, just, being a little bit more nimble, having a little bit more cash. And then, what Option Gunner was saying about the signal, Keith always says like the signal front runs a quad. And for me, it really just is that simple. It's like, why is he looking like he's leaning towards more of a quad 4? It's because the dollar's bullish trend, the range is tightened back up in a bullish stance. You have lower highs in the 10-year yield. It's tightened back up. I mean, the signals are all pointing there. It's like, I'm still bullish into year end, and I still think we can get a run in equities, but that doesn't mean I can't start positioning some things towards, a quad 4. So I like these comments a lot. Rob, thanks for doing this, man.
You're the man.
But have a good night, guys.
Yeah, you too, buddy.
Thanks, Gavin. Really
Thank
appreciate
you,
you.
Take care, guys.
Yeah, Gavin, have a good one, bud.
Hey, bro, Bruce. I wanted to finish up on your point about REITs in 2020. This is going to be more of a standard quad 4. In 2020, the concept of real estate utilization was being challenged. We already had so many sectors seem like they were impaired, if you will. So, if we're just coming off of 6% to 4%, and frankly, a lot of major asset classes within real estate are still dealing with, functional utility. We stick with the easy ones, right? Single family rentals, apartments, storage, good balance sheets. Yeah.
Yeah, I'd second that. It's funny how many people are real estate centric, particularly that have come out of the woodwork since Rob was added to the team. but knowing your asset type within the real estate sector is a big make or break. There's a large divergence in different quads.
Oh yeah, yeah. I'll be shorting the crap out of hotels.
And
forget
George,
to
I
catch
don't know
that
if you
bottom.
knew this, but yeah, so
Yeah, that's right.
Jimmy did private equity and real estate stuff like that. So he's got quite the knowledge.
I'm just
Anyway,
catching knives and cannabis and SPACs right now. That's it. That's
yeah,
all.
it's quite amusing hearing you talk like relatively philosophically about all these variations of REITs and the beta and all this kind of stuff. When I know your portfolio is basically the juiciest of juice.
I'm waiting for that January face report.
But
You know,
yeah,
like
man.
all the names
Hey,
on the naughty list that hedge funds got stopped out of. Someone's gonna fight for it.
And when you get it, your day over day returns are going to be like 20%. It's going to be epic. But
I've got tens of thousands of warrants.
I blew out of my blade warrants finally. But luckily had a win. But anyway, we don't need to get into my juice tonight. Leslie, you've been joined, but haven't really said much. Anything on your brain in your notebook today?
So I basically agree with everything Gavin just said. You're trying to get positioned, but be ready for an equity run. And everything I noticed Keith saying is tighten up net. He's talking about getting into bonds. He's talking about buying staples, utilities, all that stuff. Personally, I think gold's going to give us one more chance, and I hope so because I'm not in. But it's just a matter of tightening up and playing the opportunities in front of you, and then trying to position for the next round. And who knows how long that's going to take, because I kind of felt the same thing about this quad 2 that we just went through, which was I never really got in, felt like it was going to be too short, and just bailed and waited for the next shift, and that actually wound up being okay. And I kind of feel like quad 1 might be the same, but it might be a melt up. So you just got to kind of watch it. But I do like XLRE, ITB are probably my biggest positions right now. And then I'm sticking with SPY for a basic, just trying to trade around that one.
Yeah, and again, this is dubbed the notebook review, but we kind of go on all sorts of different tangents on this spaces here. But going back to the notebook, the underlying components, right? Like Facebook neutral today, and it was just a struggle bus out there in terms of, you had such a dichotomy of Tesla going right to the top of the risk range. What was it? Finished up like 7.5%, whatever, again. And then, then you had Facebook sort of just meandering on pretty low volume, but down a little over 1%, right? So, you've got such intimate sort of dichotomy inside of the grander kind of ecosystem. You had Pfizer that's ripping. CF Industries is, basically, for all intents and purposes, it's just been on the stick for the last like 3 days. And, the question is why, or like, what do you do with that information? And, picking your spots or trying to piece it all together. And, what I will also say, we're focused a lot on the US, but, there's definitely components internationally that you're going to want exposure to, right? Like China, I don't want to sound like a broken record, but China to me, they're set up going into, where we're kind of facing quad 4s. They're going into quad 2s. So,
and they just cut rates.
And they just cut, right? Exactly. So, it's kind of, I just would reiterate that, right? SSEC, right? And it has been bullish trend. It keeps, it kept trend. I think it kind of, Keith mentioned on Tuesday, right, or Monday, it was like right on the cusp of sort of breaking down, and it didn't, and it's bounced, and it's kind of giving you, potentially another opportunity more, what have you. Again, it's like an incremental thing. You don't need to go all in. The risk range is, depending on what you're investing in, but KBA certainly a lot slightly less volatile, I'll say, than some of the others like KWeb and stuff like that. But you're at KWeb in particular, kind of is at basically 3-year lows, and do with that what you will. I'm not saying it will break down further, but it's certainly one where I've increased my exposure. I mean, I've got probably a 4% position, right? I sold some today and yesterday, but 4% position in both KWeb and KBA. So it's definitely to me those are he signaled on EPHE today, right? So I think those are areas where you got to keep that global focus and keep that macro awareness around you as to we got to shore up the capital here in the U.S., but then where can you go internationally?
Well, I got a question for you, Robert, or whoever's been through a quad 4 with the Hedgeye process. I'm not talking about 2020, obviously, but it'll be interesting to know how the international markets do. Like, take China, for instance, if they're in a quad 2 and we're going through a quad 4, how have these international markets done while the U.S. is in a quad 4?
So I joined during like the last quad 4, aka like April of 2020. So I'll defer to somebody who's been, George sounds like he's been through, or obviously he said he's been through too. But my one commentary, Mike, is, and something that I'm certainly keeping a very tight eye on, is any U.S. listed, Chinese security, which there are a number inside of KWeb. They will, again, I haven't backtested this, but I can only assume that they would also get basically caught up in any, down, like anything, any selling momentum, right? In terms, so that's where I think sticking with sort of the KBA, which is the Shanghai listed securities, that is likely a better way of deploying your capital to get that exposure.
Yeah, you got political risk too with the stuff that's listed here in the States.
For sure.
Felix and Keith have both kind of pounded that home.
Yeah. And again, Mike, I mean, the KWeb's a bit of a trade, just where it's like, to me, it's so oversold, and it's got, basically positive catalyst on the outcome. But there's definitely, I don't know if I'd hold anything U.S. listed Chinese that's through like a quad 4, like a U.S. quad 4.
I think just to think about, if we are in a quad 4 in the U.S., that means that our economy's not doing great. Inflation's below trend, probably. At least when it's reversed, where China is decelerating, and they back, as recent as 2016 to 2018 had kind of been the GDP growth engine of the world. All of a sudden, they started slowing down. If you recall, a couple of years ago, they didn't hit their 7% GDP target for the first time in decades. And all of a sudden the market got spooked, and that was an issue. So I don't really have any specific comments to make on what the world is going to look like when we are in quad 4 and other countries are, in quad 2, like the example that you've given. But I would imagine that currency, so the dollar, even if it just moves a little bit, relative to currencies, can have a profound impact on profitability in emerging markets. They're obviously a lot more cyclical. Also, if U.S. consumers are consuming less, we're predominantly a service-based economy. If there are services that we're getting, from outside the U.S., they're going to be exposed to that change. Maybe in India, it might be going up, actually, because we're outsourcing and getting cheaper labor from there for IT services. Or conversely, maybe it's hurting Mexico, for example, because we're not going down to go spend and go to the resorts. Just things that I would be thinking about for it.
Speaking of Mexico, that signal looks really rad on a 1-month basis.
Hey, this is Steve.
Hey, Steve, welcome.
Sorry, I joined late and I wasn't on the call earlier today, but so I apologize if this has already been mentioned. But Felix Zulauf gave an interview. It's out there on YouTube. Was posted like yesterday. He gives an opinion about where he sees things going, not only over the next few months, but over the next couple of years. And I found it really enlightening. His opinion is not dissimilar than what we've been what we're all kind of hearing. But he did give some very specific points related to, international markets, gold, things that have been talked about here in the last few minutes. I'd encourage anybody to, listen to that if you have the time. I thought it was very enlightening.
That's awesome. No, thanks for sharing, Steve. And so that was Felix. Sorry, give me the last name one more time.
Zulauf. And let's see, the title is something about, big calls for 2022 and beyond.
Got it. Okay, thanks.
But anytime somebody that's a billionaire, speaks in as much detail as he was speaking, and such a clear thinker and clear speaker, I think it's worth a listen anyway.
That's awesome. I'll share that. That's awesome. I appreciate it. Thank you, Steve. Yeah. Yeah, so I don't know. I mean, if anybody has any other comments or questions, you want to dive into their notebook with, anything else outstanding?
I got a question for everybody.
Yeah, shoot, George.
It would be, so we have tax loss harvesting going on. I know Jimmy is a bit like myself, probably held on to some of the small cap names longer than I should have, ended up being valuable in tax loss harvesting at the end of the year here against some of the things that I bought and held sector-wise, like energy last November. But like, Ouster, BurgerFi, Blade, we know all these names, right? So we got tax loss harvesting going on. They're beaten down to death. When we're talking, a lot of people are talking about, do you see a mini quad one, basically? I think that would make sense, because if you're going to get a setup for the actual deep quad 4, it would make sense to have the market move in a direction that causes the most pain for the most amount of participants. So I don't know. What do people think about seeing kind of like a mini small cap quad 1 rally?
So George,
sucks
is the
people
question
back in before we actually get that quad 4.
So George, is your question that whether you should book your losses or not? Is that the question?
I don't think so.
No, that's not the question.
Okay.
Yeah.
I've already made decisions regarding
Maybe more of like
phases.
Got it.
Yeah,
Got it. So the institutional tax
I'm kind
loss
of talking about
harvesting
just
is
price
already
action going into the new year.
Yeah.
Got it. So institutional tax loss harvesting starts. I work for a very large insurance firm which has a fairly sizable book, over $300 billion. I'm not speaking on their behalf. This is for my personal investment, but mostly the institutional tax loss harvesting typically starts from Thanksgiving through to middle of December, and they just stop. After that, if any tax loss harvesting is happening, it's typically for the individuals. And if you're set up in an entity format for asset protection and other tax advantages, you don't even have to probably do that, because you'll just have a mark to market as of 12/31. So those are the two factors. I just wanted to add that for context. Now, with respect to quad 1, for the mini small caps, I think, again, it's all data driven, right? Because at this moment, we are just looking at every major feature in the model coming through with the data input, helping us gauge, and not just us. This is even the quant models that run at large firms such as BlackRock or a bunch of other places that are constantly gauging based upon some of these inputs, in addition to the positioning. Clearly, right now, there's a short covering rally that is going on, maybe to set up for setting up shorts somewhere in second week of January or later, because we are going to head into the FOMC meeting in January after the January options expiry. So to answer your question, yes, we are going to have a period of rally for a couple of weeks, hopefully. But again, it's signal driven, right? If we get excessively complacent, good time for people to start booking profits. Like I'm still holding to my complete large cap positions such as Google, Fang, all the Fang stocks. But on my small caps, whatever tax loss harvesting I had to do, I've completed that. I did not hold on to them. I don't plan to bring those on 30 days afterwards. But in certain cases, as Jimmy was saying, if we have generational opportunities, then I don't look at them from a tax loss harvesting perspective. I hope that helps.
You have a similar mindset. I really appreciate your color.
Yeah.
Knowing what you know.
Yeah. I think, if anything, for the retail investor like myself, like, we got to be careful with margins, right? Just like net exposure now, we got to bring it down. There's other ways to get in trouble and lose our duration. Going YOLO with front month call options. I've seen a lot of people do stuff like that. And frankly, some of the prices are at levels where I don't feel like I'm getting a lot of risk reward on any kind of a covered call option type of play. But if we get a technical rally and just having invested in a bunch of small caps throughout the years, like I was in C at 12.90 a share, and now Felix is shorting, right, which is a great call. But like one news release or one press or one corporate kind of action can make or break or reverse a trend on multiple durations. So like that's part of just living and dying by the sword as a small cap investor. But that being said, I think I will pick my spots, and as we get more into quad four, I'll definitely be writing a shit ton of covered calls. You got implied vols north of 100. There's plenty of ways to actively manage your position, right? Even like an 80-20, just giving myself, if I can make a little alpha on the 20%, I give myself some breathing room to wait, to hodl if I have to.
Yeah, and George, yeah, it's a good point, Jimmy. And George, in terms of like, what am I expecting? I mean, I'm kind of just going to let the Russell signal sort of dictate that, right? I mean, if whether or not, get back in for kind of a, basically it'll be a trade, right? In terms of, and right now, it's certainly making lower highs. It's negative signal, it's got negative signal strength, and to me, that's got to at least go neutral for a couple days, and then.
Do you know where the trend line is? It's got to be in the maybe mid 220s, right? Because it hit 220 today, kind of.
Yeah, give 1 second. It's in here somewhere, I'm sure. 1 second. If you want to talk about something else, you can go right ahead.
I can. One comment on the Russell. I think big picture, it doesn't seem like a good bet to take going long something that's going to get destroyed in quad 4. And also it's negative, or it's bearish trend now on the risk range. And I actually just pulled up, because I'm at my computer now, the Russell vol over the last month versus the NASDAQ vol, for example.
It's been brutal.
So what happened, I guess my point here is pre-Omicron news, Russell vol was at 25.9 roughly. Now it is at 28.3, so it's gone up, even after this rally that we've had over the last 2 days or so. So Russell vol has gone up. We know that it's a bearish trend, and quad 4 is, coming, and Keith is kind of positioning for that. Conversely, NASDAQ 100, vol heading into Omicron, it was 19.4. Now it is 18.9, roughly 19. So NASDAQ vol has gone down. This is just one data point, but it's something that supports the argument that NASDAQ vol is lower than it was heading into Omicron. Russell vol is higher than it was heading into Omicron. That, coupled with everything else, just would give me pause to think, I guess, to be making a speculative bet on small caps.
Yeah, and Jimmy, just so and everybody, I got on the 7th. I've got RVX is trending down, but the trend line was about 33 on the RVX. I don't. I went to a new notebook in December, or like late November, so I don't have all of my other notes here in front of me handy. But that's so I don't have the trend, bud. But I do have the trend, at least as of 2 weeks ago, on the RVX was around 33. So that's the important line from a volatility standpoint. So Dipsy, great commentary that RVX is still like relatively very high compared to where it has been and where it needs to go in order to really change the perception here in terms of the Russell being an investable asset class or asset allocation.
And I think again, just the factor exposures don't work. It's been hijacked by like AMC, Avis, lots of energies, lots of financials. Some of these SPACs are basically orphans, right? Whether they're rip-offs or whether they're generational opportunities, they don't have natural institutional shareholder bases. Just a lot of retailers that are also in a lot of other names. It's funny how SPACs resemble GameStop, ARK, like in different ways. And then there's all these SPAC ETFs that just get mercilessly shorted as well. So,
and the way I look at it, I paid a lot of attention to the coaching sessions from the contest, and what they were talking about very often, and Keith really liked this, was looking at the waves. And when things are surging into bearish trend, well, don't you get face ripping rallies on bearish trend? That's where you're looking for your shorts. So it's not, I'm going to jump in and ride this further. I'm going to try to scale into a short and ride it down on the IWM, and then the style factors are working in your favor.
Totally.
Yeah, I would say you can even look at what we've seen in Asia over the past month or two, where they come up and they flirt with going neutral to bullish trend just to get rejected again. So I wouldn't be surprised if there's something similar with.
That was the story.
And those are so much easier. Yeah, those are so much easier shorts than fighting the trend for a couple of points. On the worst one in an up sector, let's take a down sector and find the worst ones in there that rip the highest. So I'm looking forward to shorting AMC someday.
Good thoughts, Leslie. Good thoughts.
I have two observations that I'm curious of people's thoughts. One was just Monday's sell-off where vol went up, but gold hardly moved and treasuries hardly moved, and in fact the long end of the curve, the yield went up. To me, that kind of, and I know Keith has cited that and the change in high yield spread, those are kind of like legitimate things that should move if this was not episodic and non-trending. I'm curious if other people had that observation or what they were kind of thinking on Monday. And then my second thing was just like the rip and the reopening names like this week. It seems very odd. So I'm just kind of curious for people's thoughts there as well.
I think Go ahead.
Yeah, everybody's thinking mass inoculation and let's go. I mean, I know that's narrative, but that's what I've been kind of following. The vaccine stocks started going down.
Yeah, I think someone on the call said that maybe it was Emily, that Reagan National had their busiest day ever yesterday.
Oh,
so in the middle of all of this, you still have a lot of travel going on. I mean, you try to find a flight; it's very hard. You see the flights are all packed. I mean, again, it's like Leslie said, it's a narrative, but I think that's what's happening with the reopening.
See, the flights could also be people just rushing back to their home countries, right? Like they could be like, oh, like my sister is going to come from New York. She's now scared she can't come here to Canada because what if the thing gets locked. So it could be either or. You have to wait like a couple of days. But I wanted to actually discuss what do you guys think about short IWM and long like SPY as a pair trade for now, especially you going into quad 4?
Yes,
Because if
1,000 times
that
yes.
that's what I'm thinking. Like listening to what Leslie said too, because you can just do TNA,
That's probably been on though.
TNZ. Yeah. So can't you use that still?
TZA
Keep
or
refreshing
TNA?
that trade. It's the inverse of TNA. TZA, I think it's TZA.
Yeah, TZA.
I
use that as a hedge.
One long, one short.
TZ is the end. Yeah, exactly. Yeah. I mean,
I think the big thing is to be careful of the low volume right here. Don't put on shorts while things can rip through the low volume of the holiday. So just keep an eye on that and don't set a bunch of positions until the volume returns.
I'm laughing, guys, because Leslie texted me that earlier today because I was complaining about my short in Travel and Leisure, the magazine company, and I was just like, this thing can't fucking go any higher, and it just kept fucking ripping my face off today. And so, anyway, but
yeah,
yeah.
I mean,
So there's no
there's no sellers.
Yeah, exactly, and so
there's no, when there's no sellers, the price is just going to keep going.
Yeah, and you I mean today, I mean, I think it'll be interesting. I mean, obviously, Keith, in the morning package, we get all the volume data, but I suspect it's going to be, just kind of looking at it. Definitely was, the Nasdaq, excuse me, was definitely lower volume. Facebook, Amazon, I mean, pretty much across the board here on kind of like the big names are all weaker volume, which makes sense, being December 22nd. So kind of taking a little bit of a grain of salt with what's transpiring out there with this these moves. It's a good point, Leslie, in terms of there's no sellers, then the price actually is going to just get bid up.
Volume today was 30% below the 20-day average.
Thanks. See, Dipsy, you're just like the mathematician wizard over there. I appreciate it.
You got me on my laptop now.
I love it, buddy. I love it.
We'd love to see his notebook.
I know, man. I know. Dipsy's gonna have. You're gonna be like the in those radio shows where you got like the data guy in the corner, not in the corner per se, but in his own.
No,
no,
I get Bloomberg for work, so it's a lot easier to just hop
I'm just teasing. But that's awesome. And but no, chirp. I mean, I think that's a good point in terms of I'd had the Russell short on. I took it off, luckily, for the year before. I actually kind of took it off, I guess, last week, just with I wasn't expecting another big down day. So, but yeah, no, it's definitely one. I had put it on to kind of as a hedge for some of the small caps I still had, and then, but definitely had been, selling, textile selling, et cetera, into a number of them as well, and just cleaning up the book. I mean, that's been my biggest thing the last, like, really since kind of Thanksgiving, like most of December. It's just kind of taking the advantages of selling into strength and cleaning up the portfolio as we were, again, I mean, we were kind of positioning for that quad 1 environment, but it certainly was transitioning to much more of a quad 4, as we all know now, looking back, 1 month momentum, the traditional names are all kind of succeeded, and now it's we're trying to think about what's the next month. At least that's what my thought is that looking back, it's great because it can tell you like signal strength and where the flow of money has been, and then kind of keeping a track on that. For me, I look at it kind of week over week, right? And Keith goes through this on Monday mornings all the time, right? Week over week, month over month, 3 months, what have you. I mean, that's, I think, critical. Chirp, you were kind of texting me earlier about sort of how do I think about signal strength and, where flow is basically where, money is going. And that, to me, like looking at all that data, I do that weekly on the weekend, and it's a critical piece of my review process in terms of kind of, then I jot down, what it seems like either is phase transitioning, because that's where you can get the biggest bang for your buck, but then those can also be slight head fakes, right? So, going to Gavin's point about, investing, basically he wanted to get exposure to Xlre because of its signal strength, and he basically is of the mindset that he's likely not going to kind of touch that for a while. And I think there's, having both components in your in your belt is really important in terms of kind of executing the process.
I will say though, short IWM, long the Qs, for me, in my own opinion, is pretty nice. But you do have to be able to stomach like the trade spreading like 200 basis points against you.
Fuck yeah.
Yeah.
TQQQs, TZAs. That's how we roll.
That's the big juice out of Jimmy. Yeah.
I sold some of my TQQ, the triples today.
I mean, I fucking hope so, man. Yeah, I also sold some of those. I mean, it's up like 12. It's like up 12% in like 2 days. Turtle, welcome, my friend. What's going on the West Coast?
Hey, what's up, guys? Yeah, no, it's life is good over here. Got a little rainstorm blowing in. But quick question for Jimmy. That on that last space that you were hosting, Robert, that was great. And Rob was talking about long EQR, short MAA as a potential, like, just as an idea, not investment advice, whatever, pair trade. And it's interesting. It's just gotten, if you look at the trade, the pair itself, it's just gotten killed since really the March peak of small caps. And yeah, I don't know. Like, what do you guys think? And specifically, Jimmy, you think it's a good, kind of like back to work play, maybe like all these tech workers that move to the Midwest got to move back and get back to work. And by the way, George, awesome point. I really liked what you said about coming a plan after quad 4. I thought that was profound because I kind of missed that last time. So thanks.
Turtle, can you repeat those tickers? I'm sorry, man.
Yeah, it's long EQR, short MAA.
Got
and
it.
MAA is Mid-American
apartment
communities. Yep.
And then the equity residential. Got it. Okay, perfect. I think Jimmy got kicked out all of a sudden. Are you back, man? Hold on.
He's pulling up his old notes, probably, hopefully.
I think. Jimmy, you there?
And I think regarding Dipsy, I mean, if you work at a family office, we're on the same. Like I work at a definitely not a family office, but I run other people's money, and so through a brokerage, and so regarding the quad 4 comments earlier, I feel you, man. Like I'm already like setting low expectations, like already kind of putting money where it needs to go. But anyway, yeah, I'd love to hear Jimmy's comments if he has any.
I'm trying to figure this out. Sorry, guys. 1 second.
Hey, while we wait for Jimmy, I got a similar role as you, Turtle. I was telling my clients for a long time, once we get peak reopening, we're done with the reopening trade and we're moving on. Would it not be the greatest bull trap of all time for Omicron to get everybody inoculated, whether or not they wanted the vaccine, travel reopens and everything, and boom, that is your blow off top, and then you get your deceleration. All right, Jimmy, you're back. So
yeah.
No, that's exactly.
Yeah.
Jimmy.
No, I mean, I think specifically to EQR and MAA, apartments have done great since really a lot of last year, right? Like they're trading at really rich valuations. The point that Rob made about Camden, MAA, just the comps getting tougher and the growth decelerating in the Sunbelt region, I think it's relevant for the dedicated investor because we're still managing within our benchmark or the RMZ or it's not even the Xlre, it's the NAREIT. But for the generalist investor, I'm still thinking fund flows. They're both in the S&P. They're large companies. EQR probably has a better balance sheet. There's less development risk in EQR. It's more of a stable run rate type of company. And if this money printing has proven anything, it's just that like some of the coastal cities, the rents are sticky. One of the longer term themes within apartments is that like in Sunbelt markets, there's always a rent versus own calculus. Whenever rents get too expensive, people end up getting cheap mortgages and they buy homes and it's a lifestyle thing as well. Whereas in the city, when you're looking at like 20 times income, or whatever these rent to income, or the housing value to income ratios, it's almost prohibitive. So to the extent right now that we have multiple years even of strong demand, no new development, and just the people who are doing well, right? Like the 1/3 of the population, the 10% that's getting outsized asset gains and income gains. I think there's a stickiness there. So I haven't tracked the apartment REITs in tandem super specifically. I think your question, Andrew, was like that MAA was doing better than EQR, you said, right? Since
killing it. Since it
killing.
peaked. What's interesting is it peaked with small caps, crypto, everything peaked in March. And you could probably overlay that pair chart, and it would correspond really well with your Playboy portfolio.
I think totally. I think to be fair though, my Playboy basis is 25, so I'm still up, and I've got some calls. Right, I'm gonna ride this bad boy out.
Just stab him where it hurts. Why
Dude, I'm the Jimmy Wang of Graham F. So,
oh my God, let's not bring up.
So it's nothing personal.
But the story this year at least has been supercharged growth in the Sun Belt, and the apartment guys that have the more expensive Northeast Pacific, San Francisco type markets are just getting into their grooves. So they're going to have better comps next year. Whereas I think, when 2020 hit, the coastal cities saw big drops, whereas the Sun Belt was often kind of the destination. So, for the Sun Belt guys, they've had really very little drop off, and then the 20% plus mark to market. Whereas the coastal guys are both from an occupancy standpoint and a net effective rent, they're kind of getting back to their 19 peaks ish. So it's a base effect kind of thing. But I think, whether it's MAA or EQR, any large cap REIT that's in the S&P, I think is going to get a lot of generalist fund flows.
So if Omicron is the inoculation event, then that's the trade, huh? I mean, that's not what you said, but that's what I wanted you to say. But basically, right?
The trade is small caps and SPACs.
Anecdotally, I know so many tech workers specifically, but all kinds of people, but tech workers specifically that move all across the country. And, to some extent, they're going to have to come back. Like how many companies, are starting to, it was January. So I don't know. It's interesting. I'll just put it on the watch list.
Yeah, I mean, REITs Xlre, right? I mean, it's number 2 performing year to date. Energy's 51.5. REITs are 40, just over 41%, and then you got financials and tech and consumer discretionary kind of in the top 5, right? So it's definitely been a great place to have your money year to date. That's for damn sure.
100%. And yeah, it's been really fun, like picking Jimmy's brain. And REIT Rob's a monster. So yeah, like somebody else was saying, like it's the first time like really getting to know a REIT analyst and like kind of understanding the underbelly a little bit, just a little bit better.
I will say for the REITs though, 2020 was such a disaster of a year. A lot of these companies lost like 50%. So some of the year to date, when you look at a 2-year basis, they're either getting back to their 2019 peaks, or in a few instances, they've eclipsed it. Whereas, you look at XLK, these SaaS companies, these tech companies, they've quadrupled, they've quintupled. The price to sales ratios are ridiculous.
Yeah. Like EQR, for instance, is like basically right back to its 2019 levels. For again, it's like to your point. Yeah, it's like the base effect was so low that being up 40% is kind of like back to break even pre crash.
Jimmy, you know this. Yeah. How many people would benefit from just like a basics 101 course in REITs? What performs and when? Think about like storage, industrials versus hotels, and when to buy what.
Yeah, I mean, one of the good things, I might even see if I can tweet out like a REIT 101 primer I still get good access to Citigroup and Bank of America and Evercore ISI. They do these annual REIT primers, but I think for a lot of people who are new to the sector, it's really interesting to see that, like, as the landlord, REITs get exposure to so many different subsectors of the economy, and we have to differentiate the company somehow, whether it's by a lease term length, tenant creditworthiness, or just like exposure to geographies. So there are different ways to play things for sure.
Hey, Robert, I'm going to actually have to hop. Just wanted to say thank you again.
Hey,
and thanks
Mike,
to
always a
everyone.
pleasure. I appreciate it. No,
Yeah.
thanks for your time, buddy. I appreciate it.
Thanks a lot, guys.
Good
Yeah,
to
I
see
mean,
you.
I think we've covered a lot today in 2 sessions. So, I mean, if there's any additional questions, I mean, happy to open up the floor. But yeah, I think, Mike, it's a potentially good time to kind of wrap up as well.
Hey, Robert, thank you for the hosting
George.
these things.
Yep.
And Merry Christmas to everybody.
Absolutely.
God bless y'all. Love y'all, people.
Yeah, absolutely. Yep.
Thank you, Rob.
Thanks, George.
Yeah, totally. Yeah. Have a great, it's got a holiday starting tomorrow. So vacation starts for the next couple of days. So if I'm not as active on Twitter, you'll know why. But yeah, man, no, Merry Christmas to all. We appreciate you. And yeah, thank you for joining again. And we'll do this again next probably next Wednesday. I don't see why not. They're a lot of fun, and I certainly enjoy them. It seems like they're being well received, which is wonderful. It's truly humbling, to be honest. So appreciate you all, and we'll be we'll
everyone give Robert a follow.
That way we can record these
plug
sessions.
part 2, right?
Yeah.
Let's just give this guy some follows.
Buy all his NFTs.
I know, yeah. Appreciate it, Jimmy. It's funny. I mean, never would have thought. 600 plus followers. I mean, whatever. That's unbelievable. Let alone 1,000, which is what you need in order to record these sessions. But it definitely would be beneficial for everybody in terms of just recording these, and that way I can kind of post them up, and they'd sit out there for the week, so you can kind of re-listen to them. But appreciate everyone's time, and we'll rock and roll between now and next week.
Catch you later, guys.
Christmas, everyone.
Thanks.
Night,
Yeah.
guys.
Merry Christmas.
Have a good one. Cheers.